So today, the stock markets made new all-time highs. The Dow achieved 27,000. It touched 27,000, and yesterday and today, the S&P 500 touched 3,000. And there's a lot of factors why stocks are going up. A large part of it has to do with central bank intervention and the presentation, the testimony that Jerome Powell, the chairman of the Fed, gave to Congress yesterday. And a lot of people think he was talking about the summary of the June Fed meeting, and we have in a couple weeks the July Fed meeting coming up. And a lot of people think that the probability of a rate cut is pretty high. So there's an article here from the Financial Times. Someone reprinted it on another website. Otherwise, it's behind a paywall. And he did not commit to a time frame for possible monetary easing, nor did he point to the scale of the interest rate cuts that would be required to protect the U.S. economy from the growing risks to the expansion. And let me read a quote here. Economic momentum appears to have slowed in some major foreign economies, and that weakness could affect the U.S. economy. Moreover, a number of government policy issues have yet to be resolved, including trade developments, the federal debt ceiling, and Brexit. And there is a risk that weak inflation will be even more persistent than we currently anticipate, end quote, Powell said in a prepared remark. So basically, the Fed is looking for any excuse at all to cut rates. And the real reason, moreover, has to do with the problems in the U.S. corporate bond market and junk bond debt. Because as I talked about on yesterday's show, that for a period in November 2018 and December 2018, you had no new corporate debt issuance or junk bond debt issuance, and the Fed really started to panic. And then the Fed, Powell did that one last rate hike, and then he really started to panic. And then shortly after that, he was on stage with, I think, Janet Yellen and Ben Bernanke, and he was already talking about how basically it was a mistake to raise rates one last time, and already talking about starting to cut again, and he raised rates too much. And they were worried about breaking the corporate bond market. You know, the problems with General Electric then that started to reverberate in the corporate bond market system. Danielle DiMartino Booth has been talking about this a lot. So Brexit's actually the English economy relative to the global economy. England's economy is not large. It's only pertinent to the global economy because that's where the large banks, a lot of them, either the European banks or the American banks with their London headquarters, do a lot of their low tax, nefarious profits and market manipulations. And other than that, blaming Brexit for why you should cut rates is really, really dumb. But you can call higher stock prices, whether it's the crack-up boom if you're an Austrian school economist, or the melt-up. It's going to happen for a number of different reasons, whether that's flight. Some of the main reasons besides Fed rate cuts is flight capital. There is a lot of flight capital coming into the United States from the European Union, from Asia, from emerging markets, and a lot of people who, especially professional money managers, they're putting it in liquid things in stocks, like just buying probably index funds to the S&P 500 and the Dow. And there's really good research I talked about this earlier this year, many months ago, from Thomas Thornton. He runs hedge fund telemetry. He does hedge fund quality research, hedgefundtelemetry.com. And he was talking about how the majority of S&P 500 stocks, that I think 90% of them, it's 10% or less, are not even at 52-week highs. So it's only 10% or less of all the total companies in the S&P 500 where the shares are at 52-week highs. And this was a couple months ago, earlier this year, that he put out this tweet with some research backing it up. And those companies have good balance sheets with a lot of cash. So the majority of companies in the S&P 500, their balance sheets are not good, and their share prices are nowhere near 52-week highs. So it's the very similar principles in the Dow. What these general stock market indices also do, and it's somewhat cheating, but if you're an index fund investor, it benefits you, especially if you're just putting money in a retirement account that buys the Dow index, an index fund for the Dow or the S&P 500. If you're just indexing and not picking out any individual companies, it benefits you. It's survivorship bias. They kick companies out and they put better companies in. And this happens all the time. And this is why the Dow's not going to stay at a low levels. they always kick out the shitty companies. This has been going on for a long time. So it's not an apples to apples comparison of the Dow from the past to the Dow from now. The Dow has kicked out, Kodak because they went bankrupt. If General Electric, I don't know if they kicked them out yet, but if General Electric continues to have problems, they'll be kicked out too. And they'll be replaced with more technology companies with more free cash flow, better balance sheets, etc. So the stock market, besides the flight capital, you have central bank intervention, you have the potential for rate cuts in the near future. But in this environment now, I would say, to describe a lot of people on Wall Street and a lot of professional money managers, they view stocks, the regular stock market, as good news. Any economic data, even like a jobs report headline, which beneath the surface, the numbers are bad. I talked about this last week, that the birth-death model said that half the jobs were created out of thin air, but no one cared. It was mostly the headlines. It was these high-frequency trading algorithms and professional money managers that are short-term oriented that just saw the headline number. So good news, even if it's just a headline, is looked at as bullish for stocks. And in this environment now too, bad news, even bad news, and there's a lot of bad news, especially from a lot of the global economic data. The global economy is not doing well. There's a ton of data. We could talk about it for hours, about all the data that's not doing well in Germany, in South Korea, in China, in Taiwan. I could go on and on. There's European Union banks, go on and on. But that is also being spun, and that bad news is being looked at as good news for U.S. stocks, because then the short-term oriented people are hoping that, it means the Fed will be dovish, and the Fed will do rate cuts, the Fed will do QE, and that means then I can make, well, not I, but the person who's short-term oriented and trading stocks long thinks that they can make money off stocks, and they don't really care about fundamentals. This is a central bank liquidity-driven rally. So as you can see in my chart here, I did the S&P 500 is up over 300% since March 2nd of 2009. And besides the flight capital that has come into the U.S., and by the way, if you study financial history, what this reminds me of, what is happening now in U.S. stocks, if you go back and study, you can read Murray Rothbard's book, Great Depression. It's a good book about this. But there's other books about this as well, like Forgotten Man by Amatish Lays. And prior to the October 29th, 1929 crash, or Black Tuesday as it came to be called later, for a couple years before that, it was very, very obvious that the global economy was in a recession or depression, that Europe was in bad shape, that Asia was in bad shape. And so prior to the October 1929 crash, a lot of capital came into U.S. stocks. Years prior to the October 1929 crash, a lot of capital came in from England. The London markets came into the U.S. And so those, in combination with the margin debt, those drove up stocks. I am seeing an enormous amount of similarities to the couple years leading up to the October 1929 crash. Now, central banks are a lot more heavily involved. Back then, central banks were still on the gold standard. So FDR had not eliminated gold for Americans and gotten Americans off the gold standard, although we were on an international gold standard. FDR had not done that yet. So the central bank was still somewhat constrained by gold, although if you read the Murray Rothbard book, Great Depression, you'll see that the Fed was still cheating on the gold standard, and the Fed was creating an enormous credit boom during the 20s, after World War I and during the 20s. So combination of factors, why stocks are going higher, flight capital coming in, central banks doing massive amounts of QE with the European Central Bank, the Bank of Japan, the People's Bank of China, enormous credit bubble over there. That money does not stay in China. That money is going into real estate all over the globe, in places like Vancouver, Australia, the US, certain places in the US, and it's going into main stocks here in the US. And then on top of that, you have, and this is another thing that the central banks have also caused by manipulating debt lower, is the share buybacks. Okay, corporations, if they had to pay higher interest rates, would probably not be doing the share buybacks to those levels. But they're using the games that these large corporations play is because a lot of them cannot grow revenues on their own. They don't get I'm trying to think of the right phrase here. They don't get rewarded by the market for creating new products and services. That takes too long to spend money on research and development. Oftentimes, that means in the short term, the stock may fall a lot. And if you're the CEO or senior management of a large corporation, you do not benefit if the stock price falls a lot. You don't get your bonuses, you don't get your stock options, you don't get all those things. So there's the incentive structure now for large corporations is totally screwed up. Corporate governance is totally screwed up. And so there's actually perverse incentives now for where the management team does financial engineering to goose earnings higher because they can't grow revenues naturally and they don't get rewarded for that to grow revenues naturally. What should happen with corporate governance is the management team should be rewarded for a better balance sheet. They should get options and bonuses then for having a better balance sheet without debt, and for creating new products and services that long-term, decades out, will make the company, many, many billions, if not trillions more. But that's not what's happening now. And so with this artificially cheap debt, you have these corporations that are doing share buybacks so they can get rich quick, and then the company's in enormous trouble with debt later on, especially if revenues fall, or they're doing leveraged buyouts, which are dangerous too, because then they're making assumptions that the company that they're buying will maintain revenues or grow them. And if those assumptions are not made, the debt they just took on is going to get the acquiring company in trouble. But the investment bankers still make like hundreds of millions, if not billions of dollars on these leveraged buyout deals, which is why so many of them happen. Oh, one more thing I wanted to read. So there's actually a funny Twitter battle. This is pretty hilarious. The Minneapolis Federal Reserve Bank president, Neel Kashkari, he's getting in a Twitter battle with Zero Hedge. The people who run the Zero Hedge Twitter. I got to talk about this. Okay, so Neel Kashkari is calling Zero Hedge out on Twitter today about the stock market. And then Zero Hedge says since 2008, stocks have risen 14% annualized, home prices have risen 5% annualized, and real wage growth is negative. I guess that's counting for a real inflation rate. That's above the phony inflation data. So the Fed has been tremendously successful at making the rich richer while destroying the middle class. Go check that tweet out. It's pretty funny. So the bottom line is there's a number of these major factors. A lot of them have to do with central banks, but it's also flight capital that's coming into major U.S. stock markets, also U.S. real estate markets. And that's what's causing these asset prices to go up despite bad data from the global economy. And you guys know I'm a financial historian, economic historian, because that was my original background, was in history before I learned all these other important things. And this reminds me most of the couple years prior to the October 1929 crash, how so much capital, flight capital, came into the United States. So we have a lot of similarities to 1929. The major difference between then and now is that the central banks have even more power now to change the rules, to increase credit. They are not constrained at all by any gold standard whatsoever. So they can do even crazier things now. They can change even more rules now, and they can do even more backdoor bailouts or quantitative easing. And that's why you have these stock market traders on Wall Street and these high frequency trading algorithms that basically, when there's bad news, they're hoping that it's time for more QE, and when it's good news, they only care about the headlines and the stocks still move up. So no one really, there's going to be obviously companies that fail, but the major indexes will probably go higher. So there will be, as evidenced by the guy Thomas Thornton again. So if there's 90% of companies in the S&P 500 that are actually not doing well, that have not benefited from this enormous rally in the S&P 500, there will be opportunities to trade those stocks because they will be very volatile. Okay, this is not financial advice, just my opinion. But if so many companies are lagging, if 90% of the companies are lagging, there will be opportunities with volatility to trade those stocks. But looking more and more like a crack-up boom, or very, very similar historically to the couple years before the October 1929 crash. Comment if you agree with that below the video. I think I'm pretty much it for this short little update. Okay, bye for now.